And investors don't use leverage. I mean, that's just the bottom line. You know, you use leverage in a bear market, you're going to get slaughtered. Notoriously, when I'm accumulating, like I did a little buying of Ethereum today, I put 4% additional in my portfolio of Ethereum. That's it. You know, so I do have about a 20% position in my portfolio of Ethereum here for a bounce.
Let's take a look at Ethereum too, because I've got some targets on that as well.
Yep,
and I think
absolutely.
we might see $700 on Ethereum here pretty soon.
Yeah. And Ethereum has broken down sharply, and really Ethereum is leading the drop. I mean, if you look at the relation to Bitcoin, Ethereum, this was your 2017 high, and it's already through that. Now, I do have some levels here.
I'm not seeing your chart.
Oh, I apologize. Let me bring that up here. And all right, so here's your Ethereum chart. And again, you can see how it's leading Bitcoin. It's already taken out the 2017 highs right here. I think you have a couple levels coming up. The big one for me is going to be this $800 level right here. That's going to be a very, very big support. So again, basically below 1,000, I really start to think that there's good value here if you can say a cryptocurrency has value. No one thought it would go here. I mean, we were almost at $5,000. So at $1,000, you're basically down 80% on Ethereum, and we're getting awfully close to that, trading at 1225 right now. So yes, it's nasty, but again, if you're someone that has that long-term vision, that's right. That's right. And I mean, you know, and I'm not going to compare what's going on with Celsius or UST necessarily to like a Bernie Madoff, but that's when when Bernie Madoff was discovered was when the bear market in 2008 began, right? Because he could no longer just fabricate the X amount of gains that he was on paper, because people were saying, oh my goodness, the markets are crashing, I need to pull money out. Well, guess what? Celsius is finding the same thing right now. They've stopped allowing that. So, I mean, really bear markets expose the weak hands or the fraudulent hands. And that's what you're starting to see. And it makes a lot of sense. I mean, the crypto market is probably one of the shadiest unregulated markets out there. So in these type of environments, those bad areas are going to get exposed.
And they're going to get attacked. You know, that's what happened to Luna. They were attacked. You know, Celsius is being attacked. Michael Saylor is going to be attacked, you know, by other investors. They're going to force them to liquidate. And, you know, a lot of people are expecting and hoping the institutions will step in and prop this up. But what happens in this environment, and, you know, I guess we can talk about traditional markets next, they've got their hands full over there. So they can't step in over here while they're trying to manage risk over there. So they're not done. They're going to wait. Now they've seen this structural level crack. Now they're going to wait for $10,000, $15,000 before you see big institutional players come in, just like in the pandemic. You know, we're in risk defense mode all across the spectrum globally. So those investors don't have the capital or the risk opportunity or ability to step in right now.
Right. And that's the key, is that, you know, everyone wants the big player. I mean, it's so funny, right? You know, you see, and this has always been kind of the double-edged sword for crypto, is like, no one wants it to be, you know, everyone wants it to be decentralized. No one wants these big institutions to control so much of it. But then when you get into bear market, everyone's like, oh my goodness, I hope the institutions come out and save the day. And it's like, well, in this environment, like you said, the institutions are not, this is beyond their risk tolerance, right? Yeah. They're already cutting back risks by selling Tesla and selling some of these tech stocks. They're not going to come in into something that's dropping by 20% a day and step in at these levels. Now, at some level,
well, a lot of those have already unwound. They're already down 50, 60, 70%. Right. So they don't have the resources to step in. And like you said, they can't risk it all on this last trade, but they can step in and drive it down, because it costs way less to drive it down than it does to drive it up. And I think, you know, a lot of people don't realize that. And this is all just for people watching, just some things to think about. But all of this, you know, will ultimately create, you know, those really exponential opportunities as well once the dust settles.
Yep. And I think this goes to the kind of the thesis of like, so I've been nibbling on Bitcoin down here, and I've been nibbling on Ethereum down here as we're getting to these kind of crazy sold short-term levels. You know, some of the things that I'm intrigued by is you have something called a time count here, which is 2, 4, 6, 7 straight down days in a row. If you look at charts, they tend to bounce after. If you get 7 red candles or 7 green candles in a row, you tend to get a short-term reversal in trend. It may only be short-term, but for me as a swing trader, that's an opportunity. But again, what I'm doing here is I'm not like betting the farm, right? And people are just so insane when they do this, especially in a bear market. When you're going counter, All right. Again, so far we're still seeing, we're always hearing, oh, the traveling because COVID's, kind of down and over at this point. But I'm telling you right now, from what I'm seeing, people aren't driving as much as they were because, it takes $120, $130, $140 to fill up your tank just for a few days of driving, right? And then you also have prices that are ripping higher. We know that housing has been just going nuts, so people can't afford that with interest rates where they are. And there's this massive recoil that's starting to take place, and it can force us into a recession far, far faster than anyone thinks. I went on record, I think 6 months ago, saying we could easily see a recession start by the end of 2022 into early 2023. And I think that's going to happen, especially when prices go up on the producer side. They're not going to like raise it all in 1 month and pass it on to the consumer, because then you would see the consumer stopping to buy their goods. So what they do is they try to do it more incrementally, which keeps inflation higher for a longer period of time. We then talked about wages. I've talked about this with you before, but as good as it is for people to earn more money and get paid more, at the same time, it does cause an increase in inflation as well. And so you have all these kind of trickle through effects. And I do think inflation will come down as people recoil. We saw, I think it was Target News last week that said, they had a huge inventory, so they were going to start marking down things. So I do think inflation eventually does come down, but people are going to react to their 401ks getting cut down by 20 or 30%. Smaller investors seeing crypto markets collapse and their portfolios down 50, 60, 70%, they're going to react to that. This wealth effect that was created during COVID is vanishing very, very quickly.
Yeah,
totally. No, it's amazing. This is definitely a market that investors need to understand. So many investors came in after kind of the 2020 flush with COVID, and they've never experienced a longer term bear market. And it's kind of a wake up call. I know you and I have been through many bear markets out there and collapses, but there's a lot of the population that hasn't been. And it's like, welcome to the club, essentially. Unfortunately, it's a club that we don't necessarily want to be in, but it is a club that everyone becomes part of.
Yeah.
We're trading right at this little pivot low right here, which is around 380, 381. So that's going to be a big level to watch today going into the rest of the day. I still think these equity markets, and I think I've even said this since late 2020, 2021, is that you have to, if the Fed is really withdrawing liquidity and stopping the QE, then you're likely going back to that pre-COVID high. So that's still at 340, which is still, from the pre-market levels here of 380, we're still talking another 40 points on the spiders to the downside. That's 400 on the S&P 500. And that's, once we get there, I think you get a sustainable bounce. I don't think it's the bottom for the markets because, again, I still don't think inflation will be under control, so the Fed can't print money again. But I do think you'll get a kind of like, okay, we've washed out all that fluff and all that money from the COVID massive stimulus. Now let's kind of reevaluate with where the economy is. And then probably the next leg comes in 2023 when we are officially in a recession and people start worrying about how bad of a recession. Is it going to be a depression? You'll start hearing that. Is it going to be stagflation? All of these things could be the next leg down, but I think just what we're in right now takes us to 340 on the spiders.